First of all, I would like to thank Franklin Templeton for inviting me here. It's always a pleasure to be here in a forum like this. Hearing Sonal was actually quite fascinating because one of the luxuries that we have, we are micro investors. We aren't macro investors, and unfortunately, when you're in the macro investing business, you have to build very diversified portfolios. You have to, unfortunately, buy along with the tide. We have the luxury of actually buying against the tide and selling along with the tide. And that actually is a wonderful luxury to have.
So it is.
So this is actually the best opportunity for us. We put $1 billion to work. Last year, everyone asked why. And at this point of time, lots of people are saying, why not? And as I look at all the doom and gloom at this point of time, our team is extraordinarily busy because this actually, we believe, is one of the best investing environments in a long period of time. The last 2 years, in many ways, has generated such extraordinary noise in what fundamentally I think has always been a great India investing story. This isn't the first time in many cycles that we've seen, and Sonal talked about cycles. For example, I've been in the banking industry for 25 years. I've seen 3 cycles. There is nothing different about this cycle compared to others. And every time people ask the same questions. In fact, this is probably relatively more benign compared to other cycles that I've seen. Yet there seems to be more doom, and that's probably because media has become far more intense and fragmented. So if you ask me, I think this is probably a great opportunity. There are obviously things which are different in every cycle. The pain points that get created are in different cycles. The triggers are sometimes different. But I think fundamentally, if you believe in a country from a long-term perspective, which personally I believe in, this has got to be a great time. And so we are really very busy. Some of our peers, as you can make out, have been extremely busy as well. And it's really a picker's paradise.
In this age of new age shairi, which has also started, there's an interesting one I heard, which I think represents corporate India, Amit. Na jeene ki tamanna hai, na marne ka khauf. Na jeene ki tamanna hai, na marne ka khauf. The number you are dialing is currently switched off. So have the numbers started coming back again, Amit, because whether it's macro or micro, corporate sentiment was so low.
Yeah. It's really interesting. Mark Twain, the famous American humorist and writer, said this, I think, over 100 years ago, that all generalizations are false, including this one. So when people say that sentiment is at all-time low, I think it really depends on who you ask.
Yes.
Within corporate India, we own obviously a fairly diversified portfolio. We see opportunities. We see very different kind of sentiment in different pockets. There's the IT sector, which is actually doing quite well.
There was one tweet you could send out right after Bain Capital makes its investment. We can all follow suit.
You see, I think the problem is obviously at any point of time, what happens is sentiment and reality can be very different. But if you're in the healthcare segment, the last 2-3 years have been very difficult.
Yeah.
But if you talk to people, things seem to be turning around. But of course, I think the problem that you have at this point of time is, if you zoom out a little bit, there is a triangle of the auto sector, real estate, and really a segment of real estate, if you take affordable housing out, and agri-related segments, which essentially are struggling. And in my mind, this triangle essentially is accounting for most of the distress in the economy. In my mind, some of it is fueled, or maybe a large part of it is fueled by, some sort of credit-related distress, or vice versa. In turn, it is causing credit-related distress. If you peel the onion, in the last, few quarters, about 40% of the decline in GDP was actually auto-related directly or indirectly. That's significant, right? So I understand fiscal space is somewhat limited, but did GDP decline fuel auto stress, or did auto stress fuel GDP decline is a question we got to ask ourselves, and therefore we got to think about what do we really want to do, because, but if I was owning Hero right now, I'd be thinking about this issue really hard. And the issue is, if you actually see a 20-30% decline in auto sales, the next thing is going to be steel's going to get impacted, and you're going to have then if steel's going to get impacted, mining is going to get impacted, coal is going to get impacted, it's going to have a full multiplier effect on the economy. And so you got to really think about how, as a policymaker, you want to start reversing that. And maybe credit in some ways helps it, but if it doesn't, then in turn credit actually gets impacted as well, because credit flows through everything. Similarly, I think on real estate as well, it's exactly the same issue if you take affordable housing out. So I think, and in agri, of course, we know the entire, agri distress and what pain it has caused, including on credit. So I think we need to really figure out how to address these three, segments. The rest of the India story, by and large, in my mind, is still humming along. So therefore, I want to be careful about generalization, this whole India sentiment issue, etc. There are, of course, other questions. Promoters in generally, there was lots of leveraging, and because of everything that happened, I think people are now going through a deleveraging cycle, and they're doing it at a point of time when interest rates are high, and so they're having to sell family jewels, and so all of that is resulting in risk appetite being really low. But I think there's a lot of opportunity as well, because while all this is happening, capacity utilization is actually gradually creeping up in corporate India. And Sonal talked about the fact that there's been no real investment for 10 years. But at some point of time in the next few years, selectively we're going to see the capex cycle come back up, and that's going to be a real positive for the Indian economy, because then you're going to have both consumption and investment cylinders fire again. And so, we're actually quite bullish, and I think therefore this is actually one of the best times to start putting money to back to work. Finally, you're at a point where after a long time, mid-market premiums have disappeared. They were ridiculously high. So again, that's going to mean opportunity for long-term investors. Sure. Finally, India's MSCI, premium to emerging markets has disappeared. That again means that, at some point of time, foreign investors are going to see value and hopefully will come back in. So if you're a long-term investor, great place to come back to put money to work.
I want to touch upon one of the points you made, and again, generalizations are dangerous here, but corporate governance is the other thing that has become really a headline issue. And I think also because of the size of the companies we're talking about, the impact that we're talking about, where do you think we're on this corporate governance cleansing curve?
Yeah, I think we've made massive progress over the last 25 years. I started my career at a point of time when people thought mutual fund units were closed-ended mutual fund units were shares and should be traded at traded like that at 60% premium, 40% premium to the NAV. So from that to where we are today is, we sometimes forget, is a massive journey.
Yeah.
I started my career when, in Dalal Street, you would go deaf, standing in the middle of the trade floor, and people would shout into your ears, and you didn't even know at the end of the day what you traded, whether it was, it would get executed the next day, and a month later, whether it was for real or not. And from there to, today you have the lowest cost of trade executions. I think we must recognize that we've made massive, massive improvements. But all of this is a journey. And obviously, that journey is not perfect. Even families are, I think, learning what is acceptable and what is not. And they keep testing the envelope, pushing it. Everyone is human. We should not necessarily just blame families, because I'll tell you, even professionals will push the envelope all the time. I've heard of lots of instances where professionals will try to, engage with independent directors and try to get away with things which not necessarily are, should be acceptable. So this is human, tendency to try to get away with things which, are convenient for you. And I think it's really, we need boards to essentially get more and more independent directors to realize that they need to have much more of a voice. But I think on the journey of where we are, I think we probably need to be, if we need to be 10, we were 0 25 years ago, I would say we are a 6 or a 7 today. So we made lots of progress, and we need to, I think, recognize that.
Do you fear it's a story that repeats itself though, Amit? I mean, like you said, earlier it was the real estate companies, infrastructure companies, textile companies with embedded value. That's the stuff that went belly up. And this time round, it's a different universe, perhaps some part of shadow banking, aviation as well. But do you think there is a tendency for this to repeat itself? It's not quite, okay, this time it's different, and now we've got some really spanking corporate governance standards.
No, one of the things about markets, Mitali, is that we tend to have very short memories. I think, so what does land up happening is, look, the thing is that we will land up making some mistakes again. There will be some excesses again. Hopefully, what will happen is we will make different mistakes in the next cycle. But there will definitely be mistakes. I mean, the US markets are not perfect, right?
No, not at all.
They'll end up making their mistakes. In Europe, I mean, look at, what is happening in Europe. The fact is, the US is seeing what fiscal deficit has landed up doing to Europe, but yet they're pumping and printing, notes as if it's nobody's business. So I think people don't necessarily always learn from history, and I don't think, that's human nature, I think. So we will still make our mistakes. Hopefully we will make different mistakes and not make the same mistakes. I think people have definitely learned, and you do see at least institutional investors are making different kind of mistakes, which is the good news. I think, retail investors may make the same mistakes, but I think, and that's where the value of good, high-quality mutual funds, come in. That's where the value of private equity comes in. That at least they look back and they say, okay, at least we don't want to make the same mistakes, because then you'll be reminded, this has happened in the past, why did you do it again? I think that's clearly a trend that we are seeing.
You are privy, of course, to more closed conversations than we are, Amit. I think along with corporate governance, it's interesting what's happening with inter-promoter differences. What do you read that as?
No, I think it's no different. Whenever you have two people, you have politics. It just takes two people to have politics, and often I think you'll have, you'll have people who will disagree with something. As long as the going is good, things will go along. And the moment they something, unfortunately, sometimes things don't go well. If they don't have a good mechanism for resolving a conflict, it will spill over first beyond a personal conversation to the board, and if it gets worse, then into the public domain. And I think, unfortunately, sometimes that results in value destruction, and sometimes actually it can result in value creation. Because sometimes if these things actually were in a quiet way destroying value in the company, by coming out into sunshine, it can be a great disinfectant. So it's good sometimes that these things happen. So I think you have to really look at it on a case-by-case basis, but it's natural for there to be conflict. I don't think what is happening is unusual. It happens in every market. It is, you see conflict between investors. I mean, in the US, you see all the time institutional investors fighting with managements all the time, and then the advisories being issued, etc. So it's a very natural process.
I was just going to ask though, should it be, should you base an investment decision based on it, Amit? For example, company I has inter-promoter differences, and on the same day that there is a board meet, they also publish, their best quarterly results. So the business is actually very robust, it's chugging along fine, but there seems to be this very public spat, there are all kinds of allegations. Should you base investment decisions based on, what you see, or should you treat that as noise and look at what's happening with the business?
Yeah, I think, look, I think you have to be very case specific in these things. I think you have to look at what the nature of the conflict is. And sometimes if the conflict really is a storm in a teacup, then I think you have to go look at the fundamentals and say that the noise actually provides you an opportunity to take a long-term investment. But if the nature of the conflict is, something which can change the fundamentals of, the business and has the potential of actually being a major distraction to the management team, then I think you got to pause and say that, look, I want to actually see the resolution of this. So I think it really depends case by case on what is happening. But sometimes actually I have seen people look at the value destruction that a conflict can generate as a great entry point into a business.
I know you won't talk about the very busy conversations that are currently happening at Bain Capital, but hark back and walk us through what the Bain model is, because as you said, you're very, very micro. So give us an example of what you went and looked at in a particular story, what checks and balances came up, and how you decided, this is the time to be brave and get in.
Yeah, I won't talk about any specific investment per se, but look, I think, we typically take 3 to 7 year views on most investments. So we genuinely take very long-term views. Many of our companies, we're still holding for 7 years, because if you get a great investment, you actually want to hold on often for as long a period of time. There's nothing like the power of compounding in a good investment. What we look for, I think, fundamentally are a few things. Great management, great partners. I think that's invaluable in any market, whether it's India or anywhere else. And in fact, once you enter a company, you often, the first thing you do is actually identify, alongside with the current people you're backing, what might be the gaps in the management team, and try to help them upgrade that talent. I think that's the first thing that we do. So we actually run what's called a high performance organization exercise with the management team, and we rapidly move to actually upgrade. It sounds a little boring, but that's what we do. We try to upgrade the management team in the first 180 days because we believe that people drive businesses. And as we've looked at our portfolio over the last 30 years, the reason why it's created 20%, 25% dollar returns over a 25, 30-year period is basically because we believe it's really got to do with high-performing people. And so, we invest a lot in them. The second thing I would say is we're very clear we limit ourselves to businesses that we really understand from a vertical perspective. So we don't get into verticals that we don't understand. Those verticals generally tend to be verticals which have high return on capital. We are very clear that businesses that don't respect return on capital and verticals that don't generate decent returns structurally are things that we don't, have respect for. And also, if you don't understand, lots of businesses, for example, as we all know, particularly today, for example, in the tech space, there's a tendency to invest in a lot of these with the view that at some point of time, over a 5, 10, 15-year period, they'll return great returns. We don't understand that, and so we don't basically invest in those. So I think, we choose our verticals carefully, and we are generally choosing verticals which generally return, return high returns on capital. I think that's a fundamental. The third is, we try to invest in companies where, along with the management teams, we believe we can actually help improve outcomes. Because fundamentally, unlike what passive fund managers do, where they're essentially seeking beta, we're really seeking alpha. And so it's really important to look for discontinuity, and which is part of what we do while looking at the investment itself, which is really look for, is there something which potentially at this point of time in the investment the market is not seeing. Often markets get bored of a company. And so we look for, is the market really bored of this company because the cycle is broken, people have given up. And second, if really by partnering with this company at this point of time, can we really help them grow differentially over a 3 to 5 year period? And I think that's the other thing that we try to do. And of course, I think, what everybody else tries to do, look for everything else, which is, do they have differentiation and all of the other good things. Those are things, obviously, that we try to do as a part of our diligence process.
I don't know.
But nothing, it's no rocket science. I think it's the discipline you maintain on all these things that really, really matter. Mitali, I think that's what we try to do for a living.
I was just going to say, I don't know if the market has had the opportunity to get bored with stories this time around, Amit. It's more like it's complicated relationship where, it has gotten severed in very many bad ways. I want to give the opportunity for some audience questions before you and I get chatting again. So here's one. India's job scenario is always in the news. How do you think millions of Indian graduates can be meaningfully employed? Does it need a dash of entrepreneurship like startups? I wonder if Niti Aayog planted this question.
Yeah, I think, fixing the employment issue will require fixing the investment cycle, fundamentally. And I think, as Sonal again pointed out, unfortunately, the investment cycle got broken. And not only did the investment cycle get broken, but I think along with automation, which actually brought in efficiency into our factories, not just in India, but globally. We've actually been, in some ways, in a very quiet fashion, as people have been retiring from companies, we're actually not employing as many people per unit of product. And so what we really need to do is get back into the investment cycle sooner than later. There is no substitute to that. So if I was really a policy maker, my number one priority would be fixing the investment cycle across the board. And that's how China generated so many jobs as well. They were really ambitious, whether it was infrastructure, whether it was a few other areas. They chose a few big areas for investment, and they really opened the floodgates. I think I would be extremely ambitious on choose a few areas and open the floodgates to generate it. And I think one of the things that will happen in the next 12, 24 months is I personally feel we are at the top of the rate cycle. I do think rates will come down, which is why I think it's a great time to be in fixed income. But I think that will actually help kickstart the investment cycle as well, along with creeping up utilizations. So I think once all of that happens and investments start, I think you'll start seeing employment go up.
Animal spirits like Sanjeev Sanyal and his gang?
Yeah, I think, this whole issue of animal spirits, I think partly people are just talking themselves into, despair. I think, once rates start coming down, markets start going up, it takes very little to change people's mood. So I think hopefully, some of that will start happening, at the right point of time.
It's funny, Mr. Chidambaram tweeted right after the budget saying the one person who's feeling worst right now is the chief economic advisor. So, but here's another question, Amit. The latest budget has announced a social stock exchange for listing social enterprises and voluntary organizations. What are the benefits of that, and how do you think that'll pan out?
Yeah, I think I see this will probably take much longer term to actually work itself out. It's good that they have, I see it more as an enabling provision, and I think it's good because sometimes you need to do things even if you won't see an immediate impact. I think it shows that there's at least the willingness to bring in social enterprise into mainstream. But I'm not so sure it'll be an immediate impact. I think it'll take a good few years for social enterprise to start preparing themselves, to be able to benefit from something like this.
There's another hotly debated topic, Amit, at this conference, and generally, every time after the union budget, I think people are most wary of this 2 to 2:30 period in time, because that's when all the tax clarifications start coming in. So first you say, wah wah, bahut acha budget, fiscal deficit, bahut achhe, and then between 2 and 2:30, sentiment starts dipping, as it did this time, big time, with what happened with the HNI taxation. Where do you stand on that debate?
Yeah, no, I think I've never seen, first of all, anyone publicly give a bad rating to the budget. So,
yahi pe business karna hai,
yeah,
sir.
so I think,
Jayenge?
if you find anyone on television giving a bad rating to the budget, please garland that person. Look, I think on HNI taxation, my views, like on CSR, have been very contrarian. So I'll begin by caveating that. I was one of the few people when the 2% CSR rule was introduced, and I was very severely criticized for that, who welcomed it. On HNI taxation as well, I wholeheartedly welcome it, the increase. But I do believe that the super rich in India, I was shocked the number is 5,000, and I'll come to that, should pay a higher rate of tax to support people at the bottom of the pyramid. And I'm in that category. I feel that we do have a responsibility to folks at the bottom of the pyramid. The reason why I'm disappointed that, when that announcement was made, is not because I don't want to share that burden. I, in fact, want to share that burden. Is because I was surprised the number's only 5,000. I actually went and Googled how many Mercedes, BMWs, and Audis were sold in the country last year, which was a bad year. And the number was cumulatively, over 50,000 cars. And so that was just in 1 year. I'm assuming the super rich in India buy a car every 3 years. And so it means there's something wrong with that 5,000 number. And so I think what the government really needs to focus on is widening that 5,000 number. Because I think it's one thing to keep squeezing that lemon, and the other thing to actually increasing that pie. And so I think the effort should really be much more on increasing that pie. If they focus on increasing that pie, I think, it'll be really, really welcome. But absolutely, I think the super rich in India should share a greater burden for the sake of the nation.
Easy one this time, Amit. There's a question that's popped up saying, if you were India's finance minister, what would be your top 3 priorities?
Wow. Thank God I'm not India's finance
First, you have
minister.
to choose whether you want a briefcase or a bahi khata.
Sorry?
First, you have to choose whether you're walking in with a briefcase or a bahi khata, because now that's become the first thing to choose. After that, your top 3 priorities.
I would certainly not carry a briefcase, as you know. For many years, I've been ridiculed for wearing what I wear. So that would describe my choice would be very evident. My number one focus would be agriculture. I can bet you less than 5% people in this room would be able to name India's agriculture minister or the agriculture minister of people in their state. Despite the fact that half the population of this country is dependent on agriculture, despite the fact that, and generally people say that, okay, it's only 18% of our GDP that comes from agriculture. Half our population is dependent on agriculture. If you look at where such a large percent of our problems emanate from, how much banking loan waivers have happened, how much of the fiscal outlays have gone towards this sector, it's basically agriculture, right? I'll give you an example. Maharashtra alone has spent 70,000 crores on building irrigation related projects in the last 15, 20 years. We've spent 4,000 crores a year on drought relief. We've spent 2-3 times that amount every year on farm loan waivers. That's just one state. And if we would have focused properly on agriculture, we would have been a very, very different state, right? So the question is, why are the best brains in our country not focusing on agriculture? Why are the best brains in our country focusing on everything else? If we would have fixed agriculture, we would have actually been a very different country. Very, very different country. So if I was the finance minister of this country, I would have actually focused on agriculture, and I would have focused within that on fixing water first. Then I would have focused on fixing the supply chain next. And then I would have focused on fixing the whole issue of fertilizer subsidy and input costs. So I would have had a very, very clear agenda, and I can tell you that it would have easily added 2% to GDP of this country. You can do the math, and I can take anyone who's interested through it. So, in my view, I think that's number one priority. At this point of time, I think the other two things which are worth focusing on, of course, financial sector reform, which I think already in this budget, there seems to be some push towards with the recapitalization of banks, but I think they should not stop there. They need to keep consolidation, but very importantly, also think about what will genuinely reform the public sector banks, because 2/3 still of the assets and public sector banks. I think decision making needs to be reformed there. I think the measures they've taken from a short-term perspective to make sure that the non-banking financial sector gets stabilized are, I think, welcome. But I think credit in general, non-bank financial sector in general, I think is important. So I think that's good what's happened. I think from a immediate priority perspective, within the fiscal space available, figuring out some sort of revenue neutral, to the extent possible, stimulus for real estate and auto, because I think they are infecting the rest of the economy. Doing it in an imaginative way, I think, is very important. It will actually kickstart the economy, and that's what I would do.
Because
and I have no interest in either of these sectors.
Because you touched upon real estate, I just want to quickly ask you about that, Amit, because the opinion also seems to be that it's a bad market for whom? Because for a buyer, it's actually become a great market now. A lot of the overheated spaces have gotten corrected. A lot of the anomalies have gotten corrected. But for another, the universe that was looking at investing, sometimes flipping, often flipping, that's where it's gotten wrong.
Yeah, I think, so I think there's a lot which has gone wrong with the sector. But the problem is basically volume has actually evaporated in some segments of the market, middle and higher. The lower segment, we are still seeing volume. But I think what we need to really do is figure out a way in which two things happen. One is there is some velocity which is created in those two segments so that the pipe starts getting cleared. Because there's a lot of inventory which is stuck, and that inventory is being financed with very high cost of capital and is essentially sitting on the balance sheets of weak players. And if essentially not just weak players being then financed in a manner in which it is creating stress on the both non-banking financial system and the financial system in general. So I think we need to come up with some way, some incentives to create velocity. Once, and that can be very temporary, by the way. All of us are used to Diwali sales, right, which create velocity, right? Essentially, these can be done creatively, because if you create demand which essentially otherwise would not have existed, you can do that in revenue neutral ways, correct? So I think if we, and especially if that otherwise prevents stress, which you otherwise would have funded the cost of, then it makes sense to do it, right? So I think we need to think about how to do that, so that people also who otherwise, are sitting on the fringes get deals that they would, not have got access to, can get deals, people can get clear some of their inventory. So I think that is one thing that we need to figure out how to do. I think the second thing that we need to figure out how to do is, obviously there are a bunch of players who are stuck with unfinished projects, right? And I think we need to figure out how some of these then can be rapidly moved to completion, because the cost of those sitting again on balance sheets is really high. I think these need to be done in mission mode. And once those can get cleared, I think you'll see you'll see some sectoral resolution happening. I think these two things need to be done relatively quickly. If it can be done, I think you'll see the real estate crisis really ebbing. But I think all this needs to be people. Look, how was the GFC crisis resolved, right? Some group was convened across the board, multiplayer. It had representation, from all segments or all stakeholders, including the regulator. Decisions were taken which didn't necessarily were, player specific. And then instructions were given on resolution, and people took haircuts and people went on. And ultimately, with the speed of that resolution, the US bounced back in a remarkably quick period of time. I think that's how things need to be solved. Same thing happened with the auto sector out of GFC in the US. You got the cash for clunker scheme, and things moved on really quick. So I think we need to learn how to deal with crisis in a somewhat quick way, and we'll bounce back somewhat. With this whole, drip feed approach to life doesn't really work, unfortunately. That, crisis causes its own crisis.
Yeah. I know you have a chock-a-block calendar, and I really appreciate that you've spent time with us today, but I do want to get one more question in. Amit, you've done some phenomenal work in the world of philanthropy in the last few years, and you really have. I must commend you for that. Do you think generally, though, India and Indians need to develop more of a philanthropic spirit? Yesterday we had Tejasvi with us, who said that hundreds and millions of, not hundreds and millions, but hundreds and hundreds of people were giving up the LPG connection waivers that they got. They hope to do that with the railway tickets. Do you see that happening? Because generally Indians love a good discount.
Yeah, so you look, I think we love to think of ourselves culturally as giving people. And people will quote scriptures and will say Indians, we are generally giving, but we're very quiet about our giving. And but if you look at data, I look at data, as Narayan Murthy famously said, there is, God, and then there is data. So I look at data. The fact is, we are amongst the most miserly people in the world, especially compared to our neighbors. Even Pakistanis and Bangladeshis, Burmese are much more giving people than us. And worse still, when we give, we tend to give much more to religion than to helping our sisters and brothers in need. Our belief system is that it is better to bribe God through a, hundi than it is to alleviate distress. That's generally our belief system, for right or for wrong. Yet, amidst all of this, I think again, I go back to Mark Twain. I think it's important not to generalize. Because the fact is, the same land has produced a Jamshedji Tata who was the epitome of giving and gave away. If you look at it, I mean, even today, the Tata Trusts have as much wealth in them as close to the Gates Foundation, which is, amongst the biggest donors in the world. And he, in many ways, the Tata family, endowed as much as any other family in the world, pretty much gave away all its wealth. Mr. Tata owned less than 1% of the Tata Group, which people don't often realize. So this is the land where there have been people like that who've given away pretty much everything that they owned. I also travel. I spend most of my time with farmers outside of my responsibility at Bain, and I can tell you, when I visit rural India, I've realized that there's a deep culture of giving amongst India's poor, and lots of India's middle class is deeply giving in nature. Somehow it is actually many of our wealth creators have a hesitancy to preserve and to like to give more of it to their family. There are, of course, great exceptions like Mr. Premji, who's my role model, who think very differently, and I think we need to emulate them and think about what the purpose of wealth is. Because I do think that if we think about purpose of wealth very differently, then I think there is enough wealth in Indian society for us to make this country very different, and importantly then, for Indian policy makers and for the rest of Indian society to actually think of the top layer very differently, because there is actually a big divide today which is beginning to develop between the haves and the have-nots, whether we recognize it or not. And I think if we start behaving differently with the wealth that we are all blessed with, I think we can start bridging that gap in a very constructive way.
I think the applause says it all, Amit. I think that's something for all of us to hold on to and to really think about deeply, even as we step away from this conference. Thank you
Thank you so
very
much.
much
Thank
for
you,
joining
everyone.
us today.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.